Read this question. This is question number 6 of your June 2016 paper and part B of that. Joint arrangements are classified either joint operation or joint ventures, right? Joint operation or joint ventures. The terms of the contractual arrangements are key to deciding whether the arrangement is joint venture or joint operation. So last day we have discussed entire standard. With that we are trying to answer this question. Differentiate joint operation and joint venture in terms of contractual arrangements, rights to the asset and obligations, rights to the asset and obligations, right? Now rights to the asset and obligation for the liabilities. So by considering Roman number 2 and 1, so what is the mistake you are doing? This is for 5 marks, right? Just you are trying to explain the difference between joint operation and the joint venture, saying that joint operation means you have asset rights and rights to the asset and obligation to the liabilities. Joint venture means you have rights to net assets. Joint venture means that. That is the answer you all have given, right? If you look at examiner's comment, that is the answer, 5 marks. No, that is wrong. Examiner has clearly explained you differentiate joint operation and joint venture in terms of these two. The terms of the contractual arrangement, rights to the asset and obligation for the liabilities. Joint ventures classified as operation or ventures. The terms of the contractual arrangement are key to decide whether arrangement is a joint venture or the arrangement. Underline the word contractual, terms of the contractual arrangement. So when you have to read the terms of the arrangement properly, when it's come to practical world, so these things are very much important. It is very difficult for us to sometimes conclude whether it's a subsidiary or joint venture. So then unanimous consent will come to the picture to conclude whether it's subsidiary or joint venture, joint arrangement, right? So those things you will learn when it's come to practical world, when you work with a corporate companies, right? Multinational companies, group of companies. But here for the time being, you have to understand the way you answer, right? You have to consider Roman number 1 and 2. Now I have not explained you, I didn't explain you answer to this question. That's why I wanted to take, that's why I wanted to take this standard book to explain the answer. Now look at this point. B27, read this. The following table compares the common terms of contractual arrangement of the parties to the joint operation and common terms contractual arrangement of parties to joint venture. The example of the contractual terms provided in the following table are not that much. These are the actually contractual terms provided in the following table when it's come to joint operation and joint venture, right? Fine, read it. Assessing the terms, not exhaustive, right? Assessing the terms of contractual arrangement, joint venture and joint operation. What is the term? Terms of contractual arrangement and rights to the assets, obligation to the liabilities and revenue, expenses or profit or loss, guarantees. So these factors you have to consider when you differentiate joint venture from joint operation, right? Take first one, contractual terms of the contractual arrangement. If it is a joint venture, if it is a joint operation, first contractual arrangement provides the parties to joint arrangement with rights to the asset and obligation for the liabilities relating to the arrangement, right? That is the joint operation. Joint venture means the contractual arrangement provide the parties to joint arrangement with the right to net asset of the arrangement. It is the separate vehicle, not the parties. We understand if to be a joint venture, it should be a separate vehicle. Here, it should not be a separate vehicle, right? Not the parties that has rights to the asset or obligation for the liabilities relating to the arrangement. So now, if you read your question, right? Question says the terms of the contractual arrangement. Here also, what it is? Terms of the contractual arrangement. පොත බලාගෙන මේ උත්තරේ ලියන්න තියෙන්නේ. ලකුණු දෙකමාරක් හම්බෙයි. Second one, examiner asks you to explain what? Rights to the asset and obligation for the liabilities. Here, rights to the asset, obligation to liabilities. මේ මතක තියාගන්න ඕනේද නැහැ? Very simple, right? මෙතනම දීලා තියෙනවා. මොකද rights to the asset? Rights to the asset. Rights to the asset means rights to the asset. The contractual arrangement, if it is a joint operation, right? If it is a joint operation, contractual arrangement establish the parties to the joint arrangement share all interest, example rights, little ownership in the assets relating to the arrangement in a specified portion according to your portions, right? In the portion to the parties ownership interest in the arrangement, right? That is fine. That is operation. We discuss all these things. In contractual arrangement establish that asset brought into the arrangement or subsequently acquired by joint venture agreement arrangement assets, the parties have no interest, underline the word no interest, little or ownership in the asset or liabilities. You don't have interest on assets if it is a joint venture. Right? Obligation for the liabilities. Here, if it is joint arrangement, share all liabilities, obligation, cost, expenses, specified portion. Here, the contractual arrangement establish a joint arrangement for a liability or debt of the arrangement. The contractual arrangement establish that parties joint arrangement that are liable to the arrangement only to the extent their respective investment in arrangement. Only to the extent in their investment in arrangement, to their respective obligation to contribute any unpaid or additional capital to the arrangement. I have explained this yesterday. Now no need to keep that in your mind. You should know that. Don't remember. Take standard book and copy and paste. It's a matter of copying and paste. Now, how much you can gain? 5 marks. You required another 45 marks to pass this exam. Right? 5 marks bonus question. පොත බලාගෙන ලියන්න. මේකත් බැරි වුණොත්, which means you haven't gone through this standard properly. That's why I told you always, be careful when you refer your other study materials, which you have internet reference or downloads from any other different exams, or your classroom study materials, or your study pack. All these documents are not allowable instrument or equipments for the exam purpose. Only standard book is much more important to handle this kind of questions. Therefore, be careful, have a pre-preparation and go for the exam. Otherwise, you might not be able to handle these questions properly, right? You have to understand that. Otherwise, it will be a bigger failure, right? Fine. So with that, we will conclude SLFRS 11 joint venture. We have done one question and we have summarized this entire standard. Today, now I am planning to start another very important standard, which is SLFRS 3 business combination, right? Fine. Business combination. SLFRS 3. Business combination, right? Fine. So now, what you should understand, what do you mean by business combination? How you can differentiate it from a joint venture or associate? I told you these 3 standards, these 3 concepts: joint venture, joint arrangement, associate, investment in associate, investment in subsidiary. All these things has close relationship. Therefore, be careful, right? Okay. Business combination. I will summarize again. For your benefit, right? SLFRS 3, business combination, right? Fine. So we'll go through the standard first. So then I'll show you the relevant conceptual visualization. Again, I'm planning to do that visualization here. Later on, we'll take that. Since you have video, you can go back to the video and see. But for the time being, we'll go through this with the standard, right? Fine. When it's come to standard, first of all, you should understand what is a business. Mokada business එකක් කියන්නේ. What you are expecting from business combination, right? Here, what do you mean by business combination? That is the first thing, logical reason. What is the logic behind business combination? You should understand, right? Business combination. What? Answer this question first. Business combination means it's a asset acquisition, right? Asset acquisition. You acquired assets, acquired O and liabilities assumed. Liabilities assumed. Assumed, which means absorbed. In a business, asset and liabilities you acquired or assumed in a business. In a business, right? In a business. So this is what business combination. Business එකක තියෙන asset and liabilities ඔයා acquire කරනවා. Asset acquire කරනවා, liabilities ඔයා absorb කරනවා. Right? Which means business combination simply. Now we have to define, we have to understand this concept with the relevant standard details, right? Fine. Now go to paragraph straight away, para 3 of the standard. To understand this concept first. Identify a business combination. What do you mean by a business combination? Right? An entity shall determine whether a transaction or other event is a business combination by applying the definition of SLFRS, which require the asset acquired to be a business combination. When you identify business combination, these things should be satisfied. It should be asset acquisition, asset acquired and liabilities assumed. Two things. Underline these two. It should be asset acquisition and liabilities you have to assume in where? In a business. Consider it a business. Business එකක තියෙන assets ටික acquire කරන එක සහ liabilities assumed කරන එක කියන මොකක්ද අපි? Business combination. Since the name of the standard business combination, to acquire asset or to assume liabilities, you should have what? A business. What do you mean by a business? That is what you need to understand here. A definition of a business, vyaparaya. You are learning from O level, A level and some other exams as well. Right? No need to remember those things right now. Forget about all these things. That is for your business studies. When it's come to a business, when you define the name of the business or a definition of business, you have to follow none other than this standard, which is SLFRS 3. Right? According to this standard, they have defined this business like this. Right? Read this point. I have highlighted all these relevant points for you. Right? First we will understand the definition of business and go to the balance part of the standard. Here, identifying a business combination application of paragraph 3, right? Paragraph 3 එකේ කියලා තියෙන විදිහට කොහොමද අපි මේක apply කරන්නේ? Business combination explained in para 3. Para 3, right? B5 explain you SLFRS define a business combination as a transaction or other event in which an acquirer, which means a parent company, obtain control of one or more business. An acquirer might obtain control of an acquiree in a variety of ways. For examples, these are the points, right? What we need to understand, very important. Acquirer obtain control. When you define this word control, there are factors. You should be able to direct relevant activities. What do you mean by relevant activities? What do you mean by direction? All these things we have to discuss in detail later on, right? For the time being, understand, you should be able to, acquirer should be able to control acquiree. So these are the examples. By transferring cash and cash equivalent of the other assets, by incurring liabilities, by issuing equity interest, by providing more than one type of consideration without transferring consideration including by other contract alone, right? Fine. B6, a business combination. We are trying to define a business. Business combination may be structured in a variety of ways for legal, taxation and other reasons, which include but not limits to this, right? One or more business become subsidiaries of the acquirer, or net asset of one or more business are legal merged into acquirer. Likewise, the balance part you can read. I am not trying to read entire paragraph for you. This is also very important when you define a business. This is the interesting paragraph for me. Definition of a business. මේක තමයි වැදගත්ම paragraph එක, right? A business consists of input and process applied to those input that have the liabilities to create output. Very important. Underline the word input and process applied to the input, those input that have ability to create output. එහෙනම් business එකක process accounting හදන්න ඕනි. Process තියෙන්න ඕනි. What do you mean by that? You should have inputs. What do you mean by inputs? You should have raw material purchases, you have human resource input, you have other infrastructure as inputs, you have finance as input. By using these inputs, you should be able to process and you should be able to take what? Output. You should be able to take output. Chartered Institute is a business or not? What is input? What is input? The institute has invest money on this input, and they have prepared this raw material, study packs, and your standard books, and some other auditing standard books, lot of publication, inputs, and they have lecturers, human resource, they have administrative staff, input. All these people process. What I am doing is processing, lecturing. They are doing seminars, they are arranging different courses, processing, and finally create what? Chartered accountant. That is the output. So you have input, process and output. So then all these three should have to define or to conclude as what? A business. Understand? Very much important. Make a hungak වැදගත්. To conclude that you should have these three, right? If you have these three, you have business. So what do you mean by input, process, output? Clearly explain the standard, right? Input, any economic resources that create or has ability to create output when one or more processes are applied to it, right? Example, including non-current assets, and intellectual property, the ability to obtain access to necessary material or rights and employees, and processes means a system, standard, protocol, conventions, rules, SOPs, all these things. Processes, finally you have the results of input and process applied to those input that provide or have the ability to provide a return in the form of dividend, lower of cost or whatever, right? Fine. In a business, when you define a business, the business means you have to read B7, right? When you define a business, the relevant paragraph is what? B7. To be a business, it should have these three. But what conditions should be satisfied? There should be input, process, and output. Keep these three things in your mind, right? If you don't have these three, it's not a business, right? Fine. Thereafter, right, moving on, not only that, to be define it as a business, if it's only purchase of asset, let's say you have purchased asset of an entity, right? Business means what? Acquisition of assets or liabilities, right? ඔයා ගන්නවා asset and liabilities of a company. Asset acquired කරනවා, liabilities assume කරනවා in a business. But let's say only you purchase assets, not the liabilities. It's a business combination. No. To be a business combination, both asset and liabilities you should be able to absorb, right? If only purchase of asset, it's not an business acquisition. It's an asset acquisition, not a business combination, right? Fine. Here, this is a business combination, but only acquisition of assets, not a business combination. Here, this is not a business combination. This is a business combination, right? Fine. That you have to understand. Fine. With that, I am trying to take a simple example, right? Simple example. Suraj, better if you can take now the screen, right? So, with that standard, we will conclude the definition of a business, right? Fine. Now, let us say A acquired B, let us say 80% of shares, 80% of B, right? B, they don't have employees. No employees, right? And there is no operation still. It's a virtual company, right? No operations. A acquired 80% of B will be a business combination. Will it cover under business combination? Yes, you acquired 80% of B. Yes. Since you acquired 80% of B, can we cover this scenario through SLFRS 3, which is business combination? No. Answer is no. Why? To be a business combination, to cover under this standard, you should be able to acquire assets, assume liabilities in a business. What do you mean by a business? You should have input, process, output. To input, you should have employees. No employees in this case. There should be operation, no business operations. It's only a dormant entity. You don't have operations, right? And you don't have output. If you don't have in operation, you don't have output. So then, even A acquired B, it's not a business combination. Underline this sentence, very important. It should be business combination. It should be asset acquisition or liability assumed in a business. In a business. Business means this. Therefore, this is much more important. Put 3 star marks. Much more important can be a question, right? Examiner always, now he is testing the application, not the theoretical background of it, right? Theoretical background anyway, application check karane. You should be able to analyze and explain, right? Otherwise, you might not be able to handle these questions, right? Fine. Keep that also in your mind. Now we have defined the business. Now with this, the next thing you should understand, what is a business? Answer is this: if only it is acquisition of assets, only asset acquisition is not come under this standard, it is not a business combination. Paragraph 27, paragraph 3 and B7 you should highlight and go through. Fine. Then you should understand the scope of the standard. Scope explain in paragraph 2, para 2, right? Para 2, right? Fine. Now if you read this paragraph, right? If you read this paragraph, this SLFRS applies to a transaction or other event. Suraj, can you take this? Other events that meet the definition of business combination. Now we have defined the business combination. Already have defined it, right? This SLFRS does not apply. Scope always explain you what does not apply things, right? What is uncovered from the standard? The accounting for formation of joint arrangement. So SLFRS 11 out of the scope. SLFRS 11. Already we have gone through it. We have completed it, right? Fine. It is not applicable for this. Second one, what is out of scope again? The acquisition of an asset or group of asset does not constitute a business. Does not constitute a business. If it is not constitute a business, does not constitute a business. If so, this standard will not be applicable. Why? To apply this standard, it should be a business. In such cases, acquirer shall identify and recognize the liability individual identifiable assets acquired, including those assets that meet the definition of recognition criteria of intangible assets. If not a business, you may have intangible assets like goodwills, brand names, right? So here LKS 38, right? Intangible assets and liabilities assumed. The cost of group shall be disallocated to the individual identifiable assets and liabilities on the basis of their relative fair value, right? Fine. What I wanted to explain you here, in our previous example, A acquired B, no employees, no operations, but that company may have intangible assets, right? Intangible assets, let's say brand name, right? They have brand name. If you acquired a company with a brand name, right? Brand name, but no operation, so then business combination standard you can't apply. See, business combination of entities under common control. Common control means joint ventures, right? Joint arrangement, right? Fine. So this is the scope of this standard, right? Thereafter, you should understand, before I come to method of acquisitions, acquirer, who is acquirer and acquiree, right? We have to define acquirer and acquiree. Acquirer and who is acquiree. So before that, we'll conclude acquirer. Identify an acquirer means parent company. How do you identify parent company, right? For each business combination, one of the combining entities shall be identified as acquirer. Determine the guideline of the SLFRS 10, which is another standard when you prepare consolidated financial statement, shall be used to identify acquirer, the entity of entity that obtain control of another entity. When you determine acquirer, you have to understand, identify control of another entity, controlling power. Controlling power. If a business combination has occurred but apply the guidelines of SLFRS 10, which will be discussed next day, does not clearly indicate which of the following combination, which of the combining entities is acquirer, the factors of B14 to B18 shall be considered in making that determination, right? Fine. So, when you conclude acquirer, you have to determine the controlling power, which is there in paragraph 7, para 7, right? Then very important thing for me is determine acquisition date. Acquisition date. Acquisition date. All these things you are much more familiar, I believe, with the calculation. That's why I am a little faster when I am going through the standard, because very easily you can understand, but much more important. That's why, right? That's why I selected the standard as well. The acquirer shall identify acquisition date shall identify the acquisition date, which the date on which the obtain the control of the acquiree, date on which the obtain control of the acquiree, the date you obtain control, the date you obtain control. Paragraph 8, paragraph 8, para 8, para 8, right? Then para 9, read it. The date on which the acquirer obtain control of the acquiree, which means parent in subsidiary, is generally the date on which acquirer legally transfer the consideration acquirees of the assets and assume the liabilities of the acquiree, the closing date. So, that is the date. So, the date you acquired net assets of acquiree, you can conclude as what? Date of acquisition, right? Basically, that should be the date you obtain control over the asset and liabilities of that company, right? Fine. Very simple, important. Why this is important? For you to calculate non-controlling interest, which is minority interest or cost of control, before basically to calculate goodwill. This is very much important, acquisition rate. Why? Goodwill is the difference between purchase consideration and net asset acquired at the date of acquisition. Net assets of the subsidiary at the date of acquisition. So, at the date of acquisition, acquired date is much more important. If you select a wrong date, you might not be able to find the relevant goodwill in a business combination, right? Fine, acquisition date. So, then measurement principles, recognition principles. Go to paragraph 18. Measurement principles, right? Measurement principles. Measurement principle. Measurement principle explained in paragraph 18. So, I will show this diagram later on, but for the time being, look at the screen. Paragraph 18 explain you the acquirers shall measure the identifiable asset acquired and liabilities assumed. I told you, business combination means it's a asset acquisition or liabilities assumed, right? Liabilities you assume at their acquisition date at fair value. Underline the word fair value, right? Fair value. Fair value means what? So, at the date of acquisition, you paid the market value for the net assets of the subsidiary or acquiree. So then your cost of control account represent fair value of what? Your investment. So then you have to, since your cost of control account represent fair value of acquisition, you have to determine fair value of asset acquired and liabilities assumed. I will show you the calculations later on, but for the time being understand it, right? Measurement principle is what? Fair value. Fair value, right? Paragraph 2 will explain you that, right? Fine. So then there are some exceptions, right? I will go to that later, don't worry, after explaining this. Read this paragraph 15. So we have discussed scope, who is acquirer, acquisition date, measurement principle, and what is the business. At the acquisition date, the acquirer shall classify or designate the identifiable asset acquired and liabilities assumed as necessary to apply SLFRS. Subsequently, the acquirer shall make those classification or designations on the basis that contractual terms, economic condition, and its operating the entity policies and other pertinent conditions as they exist in the acquisition date. So all these factors you have to consider at the date of acquisition, right? Keep that also in your mind. With that, I am trying to explain you this very important concept, right? Fine. Which is measurement basis. Suraj, now if you can better to take the board, right? Here I have summarized it. Now look at this. Before I come to this is much more important, right? Put 3 star marks. Business combination is asset acquisition or liability assumed in a business. Business means input, process, output. If you don't see this, it's not a business. If you acquired asset only, it's not a business. Business we have defined. Example here, A acquired 80% of B and no employees, no operation, does not meet the definition of business, therefore no business combination. Thereafter I explain you the scope. SLFRS 11 will not apply the standard. Why? It's a joint control, it's not a business combination. Here does not apply consider a business. If it is not the business like this, it's not a business. LKS 38. Let's say this company is only a brand name, therefore no operation, no employees, only brand name. With that brand name you acquired 80%, no business. Therefore you can't apply this standard, right? Fine. Thereafter acquisition acquirer. Acquirer, how do you define? You should have controlling power. Here in more detail we will discuss under SLFRS 10, consolidated financial statement, right? Fine. Then what is then business combination. Acquisition date. Acquisition date is the date you obtain control. Obtain control. The date you acquired control. So then we want to discuss measurement principles. Always you measure at fair value. At fair value, put 3 star marks. Now look at this example, right? Look at the why we need to measure a fair value, right? Look at this example. Since I don't have space, I have to erase these things. I believe you can rewind this video and see if you want, right? Fine. This is much more important. Why? Because examiner can be tested. That's why, right? Fair value, measurement basis. It should be fair value. Why it's fair value? Right? Now let's say A acquired 80% of shares, equity shares of B. Let's say you have control anyway. If you have to 80%, you have control, right? But we can't depend on this. We have to see the ability to direct what? Relevant activities when you conclude the controlling power. Let's say on 1st January 2000, 2017. 1st January 2017. You have acquired control of B, right? So then date of acquisition is what? This, date of acquisitions. You have acquired the controlling power of B on this date. On this date, you have to make a payment. When you acquire B, you have to pay, you have to make some consideration, you have to pay something, right? I can't say pay, but there you have to, to acquire assets, to assume liabilities, you have to pay some consideration. We call it as what? Purchase consideration. Purchase consideration. Purchase consideration. How do you determine purchase consideration? Now, when you have a negotiation with B, B will not ask you, let's say, simple example, let's take, forget about business combination. I wanted to purchase a land close to, let's say, Kahatudu, right? Why I select Kahatudu, Aturugiriya, close to highway. Sometimes ago, 2-3 years ago, or before the developments of this highways, expressways, the land prices were much more lower, those areas. I can't figure it out, I can't tell the exact numbers, but let's say 50,000 per purchase. Suddenly, with these developments of the country, it has been now increased to a significant level, which means 5 times, 10 times it has increased. Now you can't argue like this. Now let's say you have, since the asset was at a low amount those days, now after 2-3 months it has been increased to this, we will ignore this price and I will pay you 50,000 rupees to purchase this land. ඇයි මාස 3-4 කාලේ මේ තිබ්බේ ලක්ෂ 5කට තිබුණේ දැන් මම ඔයාලට ලක්ෂ 5ක් ගිහලා මේ ලෑන්ඩ් එක ගන්නවා පර්ච් එකක්. සෝරි 50000ක් දීලා. මේ අවුරුදු දැන් මාස 5කට විතර පස්සේ තමයි මේක ලක්ෂ 5 වුණේ. Will the owner of that land agree to sell this at 50,000 rupees? No. Why? The current market price of the land equal or more than 500,000 rupees. So then always negotiations. So these acquisition negotiations happen at market price. Market price. Market price is what? The fair value. Fair value. Fair value. So then you purchase, you pay fair value, right? You pay the market value of this entity, not the historical value. What the market value of this B. Therefore, you have to assess net asset, sorry, fair value of net assets acquired at the date of acquisition. Acquisition. Very important word, fair value. Why we need to assess fair value? You don't understand. Right, fair value only. Why do we need to take fair value? Since you are paying market price here, market price always fair value. Therefore, here also you have to take what? Fair value of net asset. You can't compare fair value versus book value, no? Right? Therefore, you must consider what? Fair value of net assets acquired at the date of acquisition. Right? Here you have this amount. Here you have this amount. The difference you identify as what? But simply goodwill. Goodwill. මේකනේ මැජික් එකක් නෙමෙයි. ඔයා මෙච්චර ගණක් ගෙවනවා. එදාට තිබුණ මං ගෙවන්නේ මාකට් වැලියු එක. එයයි හින්දා B ගේ net asset වල fair value එක කීයද? Fair value of net asset at the date of acquisition you have to consider, and the difference is what? Goodwill. If you pay, let's say you are paying 100 million here and net asset acquired 80 million, so it's a 95 million, 5 million you have paid more ඇයි ඔය වැඩිපුර කියලා තියෙන්නේ? Since they have net asset or value කරොත් 95. Goodwill කියන නිකන් තේරුම් ගන්න එපා. There's a definition of it. The logic behind it. You have paid more. Why you have paid more for them? Beyond their net assets? Since they have reputation in the market. Now Coca-Cola, if you purchase Coca-Cola company, the net asset has different valuation, but you have to pay more value. Why? For the goodwill. Why වැඩිපුර ගෙවනවා නම් ගෙවන්නේ net asset වලට නෙවෙයි, for goodwill. Therefore, difference is what? The goodwill. Right? So this is for business combination. Sorry, goodwill calculation in SLFRS 10 according to that. Right? Fine. Now this is the measurement basis, fair value. Why fair value is coming? To picture this. Since you are measuring fair value or net asset acquired at the date of acquisition, which is 80%. 80%. You have acquired 80%. Therefore, this purchase 100 million also represent what? 80 million. 80%. Clear no? Why 80% එකක්නේ? ඔයා ගෙවන්නේ 80% වලට. එහෙනම් මෙතනත් ඔයා ගන්න net asset වල 80% එක. Balance 20%. You have balance 20% is what? 80% ඒක නම් balance 20% is what? NCI. NCI. We will discuss in detail how do we calculate NCI with simple adjustments next day, don't worry. Right, for the time being understand NCI is the difference, the balance 20%. Right. This also you have to measure fair value. Why? All these things are under fair value. So that is the measurement basis. Right. So balanced minority should be at fair value. Net asset acquired at the rate of acquisition, fair value. Purchase consideration, anyway fair value. Anyway fair value. Clear? Simple. Right? Fine. Now with this, read this paragraph. Right? Read this paragraph. Measurement principles. The acquirer shall measure an identifiable asset acquired at the date of acquisition, blah blah blah, everything is fine. Fair value. Fair value you have to consider, but there are some exceptions. Underline this word. Exceptions to the recognition or measurement principle. There are few exceptions. Those exceptions are contingent liabilities, but there are exceptions for this. What are the exceptions? Contingent liabilities, and income tax, LKS 12, income tax, already you have discussed, and employee benefit, employee benefits, and you have lease in which acquirer lease, and you have reacquired rights and share based payments. I am taking only the important things, share based payments, and asset held for sale. Assets held for sale. Asset held for sale. Exceptions, right? Asset held for sale. Right. That's all. Now, Suraj, better if you can take the screen. Sorry, right? Here, I told you, you have to consider net asset acquired at the date of acquisition at fair value. Fair value of the net asset acquired at the date of acquisition. These are exceptions. explained in the standard exceptions, right? Paragraph, according to paragraph what? Hold on. Paragraph 22, right? Paragraph 22 onwards, right? Onwards you have to read. Now I will take simple example. This is your balance sheet, let's say. Balance sheet. You have non-current assets, current assets. Let's say 100 million or 50 million altogether, 150 million. The balance sheet tally asset side 150 million. Equity plus shares reserve, let's say 30 million. Non-current liabilities, 80 million, and non-current liabilities, let's say 50 million, and current liabilities 20 million, 150 million. 150 million. This is a simple balance sheet, right? Balance sheet. Now, here you have to, when you prepare goodwill, you have to take fair value of net asset, which is equity and reserves at the date of acquisitions. Now, first exception, this is what we have discussed. First exception in contingent liabilities. Now, contingent liabilities, LKS 37, LKS 37 clearly explain contingent liabilities. Are we recognizing in the financial statements? Can we recognize this in a financial statements? No, we can't recognize this in financial statement. Why? Contingent liabilities means it's not a real liability. You can't measure the cash outflows in a probable way, right? There is no probable cash outflow. Let's say there's a case against the company, legal case against the company. A customer has filed a case against the company. Your lawyers also conclude that there's a 50-50 win-win situation. Sometimes we will win, sometimes we may not be able to win this case, right? The decision of the court is not, it is very difficult for you to conclude with evidence. Therefore, can we recognize provisions here? No, it's contingent liability. It's a contingent. Gandhabbavadi dina again, right? Vilambita, right? It's not be able to measure it. But let's say Chartered Institute release waste water to BMICH without treating them, right? Contaminate your environmental pollutions. So straight away BMICH has filed a case against CS Sri Lanka. So definitely the lawyers of CS Sri Lanka conclude that we must have to pay this much of amount. According to the history, for these scenarios, the court, the judge has charged this much of penalties. For sure we have to pay this. Still the decision is pending, but you can conclude with strong evidence you have to pay. There is no way to prove that you have done it mistakenly or anything. You have to pay, no option. Therefore, you have to apply what? Contingent liability standard. You can't recognize provision in your balance. You have to identify provision in your balance sheet. It's not a contingent liabilities in other way, right? Why? You have evidence. The future economic cash outflows you can measure in a reliable way. Therefore, you should be able to provide it. It's a legal obligation to make a provision. There are two conditions should be satisfied. It should be a legal, contractual or legal obligation. Now it's a legal obligation. By law you have to pay it. But in this case, right, some court cases you might not be able to conclude whether you are winning the case or you are going to lose the case. Therefore, it's contingent liabilities. We will not recognize in our financial statement, but according to the standard you have to disclose. Understand it. Contingent liabilities we will not identify in financial statement. It's what? Disclosure thing. But exception is this. When you prepare consolidated financial statements, right, when your assets increase, your equity also will be increased. Let's say revaluation. Revaluation gain, asset, debit, capital reserve, credit, equity increase, net asset increase. If liability increase, equity reduce. That is the ginum karana samikarana, right? Simply. But this contingent liabilities we will not recognize in the financial statements of any entity, but when you prepare consolidated financial statements, you have to consider contingent liabilities. That is the exception. They have tested this in your exam. Understand? That's why I am explaining. They have tested this in your exam. How do you recognize consolidated contingent liabilities in your consolidated financial statement? Not in the separate financial statement. This will be recognized in console accounts. Console account, yes, not in subsidiary. Not in subsidiary. Right? Not in subsidiary. How do you recognize these contingent liabilities? Now let's say if there is any contingent liability, your consolidated balance sheet or consolidated will be credit that liability, debit to where your cost of control account when you prepare consolidated financial. When you derive, you will prepare what? Cost of control account, COC. So here you will debit it. Understand? Clear? So this is the application of this standard, what you need to understand, right? So in entity level accounts, you will not identify these contingent liabilities. Entity level subsidiary, they apply LKS 38, but when you prepare consolidated financial statement, if there is any contingent liability, in consolidated financial statement, it should be credit and cost of control account what? Debit. You are taking that through the impact of that through cost of control accounts, not the entity level specific accounts. Why you can't identify contingent liabilities according to LKS 38 in separate financial or entity level financial statements. Now these are the exceptions. I recommend you to go through income tax, employment benefit, leases, share based payment, asset held for sale and held for sale. This is not a part of your standard according to your study pack, but examiner has tested. That's why I am explaining, right? That's why I didn't consider these things exceptions into my previous conceptual visualization. This but examiner has tested. Why? Examiner can test anything from your standard. Therefore, keep this also in your mind, can be tested, and this time out of these things can be tested. Keep few things in your mind. Don't try to remember මෙහෙම ටිකක් තියෙනවා කියලා දැනගන්න. exceptions ටිකක් තියෙනවා. මොකද income tax, employment, lease, share based payment, asset held for sale. Straight away go and copy and paste it from where? The standard. That's enough. ඒක කරගන්න පුළුවන් නම් ඇති. Standard එක පොත බලලා ලියා ගන්න පුළුවන් නම් ඇති. There is a question related to this. We will discuss that question next day before we start SLFRS 10, which is business combination. So please ready with some empty papers. We will discuss one simple question from consolidated financial under preparation of consolidated financial statements, and on that day I'll explain the term of controlling power. How do we define controlling power? That is also much more important, and logic behind goodwill calculation and logic behind NCI calculation. Most of you will have some මතක තියාගෙන ඉන්න කටපාඩම් කරන තියරියක් මේක පිටිපස්සා, that is not applicable. With that you might not be able to handle exam questions, right? What you should understand, the logical arguments behind these goodwill calculations, logical arguments behind these NCI calculations. That is what is much more important when you handle exam questions. I am not trying to discuss much more complex exam questions, but I will take simple model paper question. That model paper question will explain you the logic behind all these calculations. Keep that in your mind and apply that, right? So consolidation is not a big thing, right? It's a matter of taking subsidiary balance sheet and take your parent's balance sheet, combine all assets and liabilities, take the your portion of net assets and eliminate all intercompany balances, unrealized profit and gains. That's all. We'll do that question next day with understanding of these logical reasons, right? Fine, thank you. Right. So after SLFRS 3 business combination, we want to discuss SLFRS 10, which is for consolidated financial statement. Before I start that standard, so look at the summary. So based on the control, right, based on the controlling power, we can decide whether it's a subsidiary or whether it's a joint venture or whether it's an associate company or just an investment. So today, after SLFRS 3, I told you I will start SLFRS 10. So before I come to SLFRS 10, better if you can understand this whole picture relating to group accounting, right? Fine. So very important word I told you, controlling power, right? So based on that only you can decide whether it's subsidiary or whether it's joint venture or whether it's associate or any other investments. There are 4 things: subsidiary, associate, joint venture or just trade investment covered under SLFRS 9. Look at this. Control alone. If you are controlling alone without a support from any other party, right? You are controlling another entity without support of any other party. So then yes, if you are controlling alone, yes, consolidation in accordance with SLFRS 10, right? So after this slide, I am going to discuss this standard with you, right? I told you I will discuss one simple question related to consolidated financial statement, but not a comprehensive question. But those who are not much more familiar with that standard, you can keep those things in a logical way after that question, right? Fine. Disclosures accordance with IFRS 12, right? SLFRS 12 in other words, right? Fine. So this is, if you are controlling alone, it is applicable what? SLFRS 10, consolidated financial statement. On other hand, you are not controlling alone. If so, you need to see whether some other party is joining with you to control another entity. Yes, if you are not controlling alone, it's what? Joint control. It's joint control, yes or no? Yes, it's a joint control. If so, define type of joint arrangement, SLFRS 11, in accordance with SLFRS 11. So SLFRS 11 explain you, already we have discussed, there are 2 joint arrangement. Either it can be joint operation or joint venture. You are controlling with some other party, yes, so it can be joint arrangement, either joint operation or joint venture. Joint operation, account for sales, liabilities, revenue and expenses, equity, sales, liabilities, revenue and expenses, disclosures in accordance with SLFRS 12. So here joint operation explain. Joint venture, accounting for investment in accordance with IAS 28, which is equity method, disclosures in accordance with IFRS or SLFRS 12, right? So here applicable LKS 12, here SLFRS 11 and 12, right? Fine, for disclosure requirement IFRS 12. So joint venture and joint operation, if you are controlling another entity with 1 or 2 other parties. If you are not controlling with some other party, right, no joint control, no single control, you are not controlling alone or you are not controlling with some other party. So significant influence, right? Whether you can put significant influence. Yes, you can put significant influence on another party, right? So we will discuss in detail this, what does that mean, significant influence, today itself, right? Significant influence, yes, account for investment in accordance with IAS 28. If not, IFRS 9, which is just and trade investment, financial instrument. So this is the entire summary of SLFRS 11, SLFRS 3, SLFRS 10 and IAS 28. What you need to understand here, you apply LKS 28, which is accounting for joint venture and associate, if you are in joint venture as well as if you are in associate. So this is very important part. So this is a summary, right? This is a summary. Those who are still not familiar with these 4 standards, right, 4 methods, this is good slide to understand the entire picture, right? Fine. So with this, I wanted to start after, just after SLFRS 3, SLFRS 10. So I told you under this I will do small calculation for preparation of consolidated balance sheet and the goodwill and the way you calculate minor interest. With that we can understand the logic behind all these elements or topics, right? Fine. Accounting for consolidated financial statement SLFRS 10. Here I told you, right, Suraj, better if you can take this board right now, thereafter we can go straight away to discuss standard with the standard book, right? Fine. SLFRS 10 consolidated financial statements. Financial statements, right? Consolidated financial statement. Again, I am repeating the same. You should have this conceptual visualization or the summary in your standard book. Before I start any of the accounting standard, I am repeating this. Why? That is that much important, right? So in the same summary, the same visualization, you must include the relevant paragraph number also for you to handle exam questions very easily, right? This is very important. Why? Because always you don't have calculation nowadays. You have to interpret the accounting standard. So for you to interpret, you have to take some elements, some data from information from standard. So for when you take information from the standard, straight away paragraph numbers are much more important. Don't remember, try to understand in a logical way, right? Fine. Here, when we are talking about this SLFRS 10, first of all you should understand consolidated financial statement. What do you mean by consolidated financial statements? Consolidated financial statements. What do you mean by consolidated financial statement? First of all, you want to understand this, right? What do you know right now? All right, there is a company, he is acquiring whatever the percentage of another entity. Therefore, we are preparing consolidated financial statement as explained in the standard. Yes, but standard explain you consolidated definition of consolidated financial statement. Consolidated financial statement means, right? So your parent company, right? Your parent company, always you have a parent. Parent company plus your subsidiary present single or one set of financial statements or present single financial statements. Single financial statement, consolidated, right? Right, fine, that is. You have a parent company and you have a subsidiary, both together you present single financial statement, which is consolidated financial statements. Very simple. So this is also people, students will understand, right, what does that mean? What he is explaining is a very simple thing, no? Right. Yes, it is simple. But if someone asks from you, what do you mean by consolidated financial statement? Most of you will give, you are combining balance sheet, you are combining what? Income statements. No, that is not the technical answer. Technical answer is this. Present parents company and subsidiaries financial statement in a single set of financial statement. Very clear, right? Standard explained. This is not my definition. Standard itself explained this. When you prepare consolidated financial statement, when you present subsidiary and parent company's financial statement together, what is important? I told you the golden word of this standard, I would say, right? Golden word of this standard. Controlling. What do you mean by control? What do you mean by control? If you don't have control, the standard is not applicable. So for you to apply the standard when you prepare consolidated financial statement, you must understand the definition of control. Right? Earlier, it was the percentage of acquisition. If you are more than 51%, you prepare consolidated financial statement. Nowadays, no. You must have what? Controlling power. If you don't have controlling power, you will not prepare consolidated financial statements. So then you will see whether you can control an entity with some other party. Yes. So then jointly control. So then joint operation or joint venture. If you don't have that control, again associate. If you can put significant influence without control. If further no, trade investment, ICASL 9. So entire story of group accounting depends on the word control. That's why I told you the golden word of group accounting is what? Control. Right? Fine. What do you mean by control? So control depends on three things. Don't worry, I will come to the standard later after summarizing entire standard. Right? Control depends on three things. Number one, power over the investee. Standard explain this, right? Power over the investee. Investee, these are words from standard. That's why I can't change it, because you are referring what at the exam? Standard book, right? Therefore, I need to use those words. Investee means your subsidiary, right? Power over, how much you have power, how much of power you have over the investee. When you define this power, there are factors to consider. Therefore, what is very important to understand power, right? So this has been explained in this standard. We'll come to that later, don't worry. But for the time being, understand, to define your control, first requirement is what? Power over the investee. So then, if you have power over the investee, then you have to consider with power exposure or rights to variable return. Exposure or exposure or rights to variable return. Exposure or rights to variable return. What do you mean by exposure rights to variable return? Rights, exposure, rights to what? Very important word, variable return, right? Plus. When you define control, these two must be there. If you have only power, you can't prepare consolidated financial statement. You should be able to, you should have exposure or rights to variable return. Right? We'll see in detail, don't worry. What does that mean? I'll explain. Third requirement to prepare consolidated financial statement, link between power and the return. Link between power and the return. Link between power and the return. So these three factors you must consider when you define the word power. If you have power over investee, if you have exposure to or rights to variable return, and you can use power and the variable return to direct what? Relevant activities. I will come to that later. So then that will explain link between the power and the return. So if you are fulfilling these three, yes, you have control over subsidiary or investee. So then you can prepare what? Consolidated financial statement. If you don't have this, no consolidated financial statement, you can't apply even SLFRS 10. I believe this is very clear. Right? Fine. Now we have to understand in detail what is power, what is the meaning of exposure or rights to variable return, and what do you mean by link between power and the return. So we will take one by one. Thereafter we will refer this summary to the standard. That's all. Right? Fine. So when you define power, power means rights. Sorry. Power means rights that ability to direct relevant activities. Much more important word in this case, right? Ability to direct relevant activities. In short, right? Relevant activities, right? Relevant activities, you have to define relevant activities, don't worry. We will see what are the relevant activities with the standard. For the time being, understand this summary. If you have rights, or if you can, rights that ability to direct relevant activities. If you can direct relevant activities of the investee, you have a power, you can prepare consolidated financial statement. Right? Together with this two. Right? If you are satisfied with this, only you can prepare consolidated financial statement. But this is what explained under this area. Right? Fine. So when here, what is two very important words for me? Rights and ability to direct relevant activities. Relevant activities. Those two are much more important for me. Right? Those two are important for me. I have underlined this in red, explain here. Right? I have to explain these underlined words also here. Understand the logic. Right? So then I have underlined here rights and relevant activities. Therefore, again I need to look at rights and relevant activities. General layman definitions are not relevant in this case. Right? But we need to understand the standard definition of these words. Right? Standard explain you the word rights. Rights, right, and relevant activities. Still I know you don't know what does that mean, right? The definition of relevant activities. I haven't given you examples. For the time being, understand this entire standard, then we will put examples to. I will plug examples to here. After that, we will continue with what? Accounting calculation, application of this standard to consolidated financial statement. Rights. Rights mean, simply keep this in your mind, voting rights, voting power. Voting power. Voting right basically. Voting right. Right? Voting rights for what? Shares. Right? Shares. So for when they take economic decisions, they will ask voting power, votes of the shareholders. So then the power you have over that is what? Right. Right? Okay. Relevant activities. Relevant activities means activities significantly affect investors' return, investees' return. Right? Activities significantly affect activities significantly affect investees' return. Right? So what are the activities significantly depends on significantly have impact on investees' return, right? Investees' return. So basically, what are the key activities driven by this company, right? Relevant activities. If you can direct, right? If you can direct this significant list of activities, yes, you have power over investee, right? What power එක තියෙනවා කියලා කියන්නේ කොහොමද? වාගේ voting rights that ability to direct relevant activities by using your voting rights to what extent you can direct this list of relevant activities of investees. What do you mean by relevant activities? Activities significantly affect investees' return. Investigate profit එක derive කරනකොට what are the key activities involved, right? So based on that you can define the power, right? Power. So what are the examples for these relevant activities? Examples, right? Examples. So examples also little important, right? Not little, much more important. Examples. Examples. So these are the examples for relevant activities, right? Sale and purchase of goods or service. Sale and purchase of goods or service. Service, relevant activity. So if you can direct sales of the investee, if you can direct purchases of investee, you have power. Example. Example. Second one, disposal of assets. Of assets. So if you can take decisions on disposal of the assets, so then you have power. Those are relevant activities, right? Relevant activities. And research and development on new product, R&D of new product or service. Service, relevant activities, right? And managing financial assets. Financial assets. Financial assets. So these are the relevant activities defined in the standard. So if you can direct these relevant activities, yes, you have power over investee. Understand? Very simple, no? There's no rocket science here, magic. There's no magical concept here, right? If you can understand this flow, this is the flow. Very simple, right? Fine. So we have defined power and we have examples over that. So these examples as it is I took from where? Standard. These are not my interpretations. I am interpreting what? The standard, right? Fine. Exposure or rights to variable return. Here we have discussed that word. Activities significantly affect investees' return. What return? Variable return. So to define or to decide control, the second element is that exposure or rights to variable return. So what does that mean? Variable return means not a fixed thing, not a fixed. That is the first thing you understand. Not a fixed thing, right? Not fixed. Not fixed, right? And not fixed means it's vary. Vary with what? Vary as a result of the performance. Vary as a result of what? Performance, right? Right? So based on the investee's performance, your return, rights return, variable return is not fixed, right? You don't have fixed return from it or investee. So if not fixed, vary how? As a result of the performance of the entity. So that is exposure to rights and rights to variable return. What do you mean by variable return? Examples. I told you examples are much more important. Very first day I told you, you should, to pass this exam, there are 4 golden rules. What are they? Conceptualization. This is what I am doing right now. Conceptualization. I am conceptualizing the entire standard, right? I have gone through the standard and I have done this for you, right? This is not a rocket science. This is not there in the standard book, but I have summarized in a logical way like this, right? So this is conceptualization. Make a but you should understand this link. So then exam එක ගියා මේ හැමතැනම paragraph අපි insert කරනවා. ඒක බලන්න exam question එක help කරලා. That's all. Right? Examples. Dividends. Depends is not a fixed thing. Dividends depends on what? Organization's performance. It's not a fixed thing. It's a variable return. Commission. Royalty. Right? Management fee. So all these things are what? Variable return. So everything will not fix, change according to the investee's performance, right? So you have exposure or rights to variable return. You have rights to receive dividends. You have rights to receive commission or management fee, whatever, right? So these are the examples for variable return. So then final one, the last one. Last one explain you what? Ability, link between between power and the return, which means ability to use the power to affect investee's return. Ability to use power to affect investee's return. Very simple. No link is that. So you have an ability, right? You have an ability, link between these two, ability, power and the return, power and the return, right? Ability to use this power, this is the link I am explaining between these two. Ability to use this power to affect investee's return is what the link between power and the return. So if you don't have, if you have power, and with that power, if you can't use this power over this variable return, you don't have control, right? If you can't use this power over this variable return, you don't have control. So that is the link, ability to use this power to affect the investee's return. By using this power, you should be able to change this, right? If you can't change this, variable return, you don't have power. So this is the summary of power, right? If you are satisfied with these three, yes, you have power, then you can prepare consolidated financial statement. In summary, this is the definition of the word control. Much more important, right? Much more important, right? So then what you need to understand, consolidation, accounting treatment, accounting requirement. Third one, accounting requirement. Accounting requirements, right? Accounting requirement. So when you talked about accounting requirement, right? Here, first of all, you understand, if you are deviating from these three, you can't prepare consolidated financial statement. Why? You don't have the control. First of all, you understand that. So this can be a question in your exam, not relating to calculation, but when it's come to interpretation of that standard, right? This is how I can interpret the definition, the definition of this word, which is control. If you have a control, you have to prepare consolidated financial statement, no doubt. If you have control, you must prepare consolidated financial statements. When you prepare consolidated financial statement, how do you prepare consolidated financial statement? In explaining same standard under accounting requirements, under accounting requirements. So these are the accounting requirements. So under standard, so the relevant area, name it as consolidation procedures, right? Under consolidation procedure, this has clearly explained you, right? Consolidation procedure. So consolidation procedure, this is much more important when you prepare consolidated financial statement. So I know you have prepared many consolidated financial statement, no doubt. No doubt you have prepared many consolidated financial statements. I know that. But you haven't done this. What is that? You haven't gone through the standard. Your classroom lecturer explained you how the way you should calculate goodwill. Your classroom lecturer explained you the way you calculate minor interest earlier, non-controlling interest. You have applied those techniques, maybe in a logical way, maybe by keeping double entries in your mind, but I am sure you haven't gone through this. So your lecturer explained you that consolidation, the way you prepare consolidation financial statement by referring to the standard. The standard explain you three things. What are they? When you prepare consolidated financial statement, you must combine asset, liabilities, expenses, income, and equity, right? Combine, first procedure, first combine asset, liability, equity, expenses and income. You have to combine these three, right? Combine. When it's come to equity, you will not add line by line. There's a different treatment, but I'll explain you, right? You have to combine one by one. What is investee's asset and what is parent company's asset? Combine together. Take all liabilities, apply whatever adjustments if you have, and combine investees and investors' liabilities, which means parent and subsidiary. First thing is that. Second thing, offset current assets, offset carrying amount of investment in subsidiary. Second one, offset carrying amount of the investment made in subsidiary. In your parent's balance sheet, you can see investment in subsidiary. You have to set off in. Once you prepare consolidated financial statement, you don't have that investment, right? You don't have that investment. Second step is that consolidation procedure, right? Consolidated procedure. Third one, eliminate intercompany asset liabilities if there is any. Eliminate intercompany asset, liabilities, equity, expenses and income. So this is what consolidation procedures, accounting requirement, not a rocket science. Only 3 steps you need to follow. But you are trying to do what? Your understanding is what? This is very difficult thing. So therefore I need to keep cost of control accounts in my mind. මොකද debit වෙන මොකද කියලා කටපාඩම් කරනවා. Right? ඔයා දන්නේ නැහැ මේ offset මෙච්චරයි කියන එක ඔයා දන්නේ නැහැ. Only 3 things you have. Combine asset, liabilities, equity, all these things, and set off current carrying amount of the investments in subsidiary. Eliminate intercompany balances. So when you perform these 3 steps, you have to calculate goodwill and post acquisition reserve and non-controlling interest. So all these things. Those are sub elements of those, but mainly 3 steps. So when you perform these 3, you can prepare what? Consolidated financial statement, which is not a rocket science. Very much simple, not that difficult, right? Entire standard which are relevant, entire standard when it's come to your exam, I have summarized here. So this is not the full standard summary, but when you map the standard with your study pack, so these are the significant or much more important things that you should understand. Very simple, right? Very simple diagram, right? මේක මතක තියාගන්න ඕනේද? නෑ. ඔය මතක තියාගන්න මොකද්ද? Consolidated financial statement කියන මොකද්ද? standard එකේ තියෙනවා. control කියන එක තමයි වැදගත්ම. මේක මතක තියාගන්න ඕනේ. This is much more important. So මේ මතක තියාගන්න එපා. So keep this is in your standard book. Standard book එකේ තියාගන්න. So then when you prepare consolidated financial statement, all right, these are 3 steps. After that, there are some other important areas as well you must understand, right? Fine. That is, so those are very much important. Those are also that much important when you prepare consolidated financial statements and accounting requirements, right? Fine. Next thing you should understand, reporting date. For what date you should prepare financial statement? Reporting date. Reporting date. When you prepare consolidated financial statement, right? Let's say your subsidiaries financial statement you prepare in a different date. Let's say 31st December 2015 or sorry, let's say 18. But parent prepare consolidated financial statement in 31st March 2019. So 2 different periods. So can you take financial statement of subsidiaries for 12 months ended as at 31st December and consolidate financial statement of parent prepared as at 31st December March 2019? Big question mark, no? You should understand. Here I explain you standard, same date of the parent and subsidiary, same date in both parent and subsidiary, right? But let's say parent prepare consolidated financial statement as of 31st March, but subsidiary prepare financial statement based on 31st December. So then how do you handle that? I will come to standard and explain you. But it should be same date means not the same date, but you have to take proportionate part of it, right? That is possible, right? We will discuss that when it comes to that point. Therefore, reporting date also much more important, right? And you have to understand another thing, right? Loss of the control. What will happen if you are losing this control? Loss of control. Much more important. Can we prepare financial statement if you are losing control over investee? Let's say 2015 you acquired this investee or the subsidiary and you prepared you had control, therefore you prepared consolidated financial statements, but you are going to lose the control over investee, right? Control over investee from let's say 1st April 2019 onwards. If you are losing control, can you prepare consolidated financial statement when it's come to 31st March 2020? Question mark. We'll discuss. Little important, right? Next one, non-controlling interest. Non-controlling interest. What you should do on minority? Majority is this. That's why early standard explained minority interest, right? Minority interest. Now standard has been changed. Why? Because now it's not the minority. Percentage is irrelevant right now. That depends on the what? Control. No. Earlier, if you have 60%, 80%, yes, you prepare consolidated financial statement over 51%. Therefore, earlier it was minority interest. Minority is that, no? Majority is 80% or the 51. Majority. Minority 49. If you have acquired 80% majority and 20% minority. But that is not applicable after the change of the standard. From that day onwards, it was what? Control. When they brought this word control to the standard, minority interest changed to what? Non-controlling interest. If you are controlling consolidated financial statement, if you are not controlling, it is what? Non-controlling interest, right? Non-controlling interest means the balance part of it, right? Control karne kada ani pedda. What is the accounting treatment over this? How do you deal with this minority interest? So this is the entire standard summary. Much more important areas I have taken into this summary. So now look at the entire summary. I will explain. I will take 1 minute to explain entire summary, right? SLFRS 10 consolidated financial statement. Before you prepare consolidated financial statement, what you should understand? What is consolidated financial statement? Consolidated financial statement means parent, investor and investee prepare present what? Single financial statement, single set of financial statement. If so, we identify those as what? Consolidated financial statement. For you to prepare consolidated financial statement, the percentage of acquisition is not relevant here. What is more relevant? Controlling power. So when you define controlling power, there are three things you have to consider: power over the investee, exposure or rights to variable return, link between those two. When you define the power over investee, power means rights, that ability to direct relevant activities. What do you mean by right? Voting right. Ability to direct relevant activities means, relevant activities means what? Activities significantly affect on investee's return, right? Exposure over rights to variable return. Variable return means not fixed, not fixed. Not fixed means vary as of the investee's performance, right? Investee's performance. What are the examples for variable returns? Dividends, commission, management fee, right? You should have power to change it. That is the link between power and the return. Ability to use power to affect the investee's return, but the ability to use this power over this variable return. If you have power, but if you don't have any, if you can't affect, if you can't put impact on this variable return, you can't prepare consolidated financial statement. Why? These three conditions are not satisfied, right? Fine. So that is the definition of it. Then accounting requirement, only three things, right? When you prepare consolidated financial statement, combine assets, liabilities, equity and so on, offset carrying amount of investment in subsidiary and eliminate intercompany balances. So when you perform these three, you prepare cost of control account to calculate what? Goodwill, and you have minor interest account and post acquisitions reserve. All these things are much important. Reporting date should be the same date, but sometimes that may not be the case. If so, standard has explained you the treatment, right? Paragraph numbers I will insert later, don't worry. Loss of control and non-controlling interest. So those two also much more important, right? Fine. So this is the entire summary of the standard. Now we need to look at this summary with the standard SLFRS 10 to insert paragraph numbers. Why? Can I do it right now? No, I can't remember those things. I am not trying to remember the relevant power. I can't para. I can't do that. Therefore, I have to refer standard and I have to insert paragraph numbers to here. Right? Even I can't remember. So what about you? So that is, you should understand. Try to understand this visualization conceptual diagram. Thereafter we can apply what? The relevant paragraph to this one. So then pick the relevant paragraph from this and go to standard and handle exam questions, right? Fine. In next session we will do that activity. We will go through the standard and insert paragraph numbers, right? Thank you.